Okay, so chapter 2 covers master budgets. Um, so I love this chapter. I feel like it is my life and the things I deal with a lot. Um, and I feel like it's really like rational and logical, but I think that's mostly because I've done it so much. It may not be so rational and logical to a person who's not dealt with it at times, for years and years. But when we run a place like the college, we've got this big, massive budget, $50 million a year. But it's hard for like one person to sit up there in the vice president's office and just like make a budget and like hand it out to everybody. Here's your budget. So instead what he does is he goes out, so each of the academic divisions, so like I'm responsible for the business and computers division, we create a budget. Budget's a lot based on what we've done in previous years, but we might have to add things or change things each year. So each year I make a budget, social sciences, math, each division makes a budget. And then the non-academic departments, computer services, financial aid, they each make a budget too. We pass those budgets up to our bosses. Mine would be the academic dean that's over my area, and they approve it or not. Sometimes they come back and say, I have a concern with this, right? So there's this give and take. Once it's approved at that level, it goes up to the chief financial officer or the chief business officer of the college. And he does take it to the vice president, who kind of just approves, but it's really the chief business officer who deals with it. He takes all these little budgets and compiles them into a master budget for the entire organization. At times when he's doing that process, he has to go, that can't be, we can't do that. So there's like these various levels at which it could come back to you and say, hey, we can't do that. It's especially if you're budgeting for something like an unusual cost. Something that we've been trying to budget for years, but we've been struggling to get through because of financial constraints, is repaving this parking lot in front of the Fine Arts Center, right? It's in bad shape. And if you notice the way the college is kept, that's unusual. The college is usually kind of immaculate. Like all the buildings are really nicely kept. All the grass and lawns are really nicely kept. But I guess it turns out that parking lot is going to require more than just a resurfacing. You're going to have to pretty much dig it up, re-prep it, and so it's a big thing. And I think what they're doing is putting money aside each year until they can afford to do it. And so that's the sort of thing. So the person who controls the master budget at the top is really trying to keep a lot of things, juggle a lot of things and keep them all in the air at the same time. We need new computers in this lab. We need a new parking lot over here. And the way it works best is to have input from the lowest levels, saying this is what we need, coming up to the highest level. Okay. In addition to all of those expenditure budgets, we also have revenue budgets. How much do we expect we're going to bring in? Right. We have to plan for that. How much in tuition revenue are we going to get? How much in state aid? How much in other revenue sources? We do some things where we make revenue by charging additional fees for certain courses, or we contract with the Arizona State Prisons. We contract with Gila County, and they pay us a certain flat fee to manage things for them there. So we have to manage all of that, and as you can imagine, it's not always easy. What do you think is the single biggest expenditure that Eastern Arizona College faces? What would you guess? Salary and expenses, or salary and wage expenses. Salary and wage expense makes up between 70 and 80% of our overall budget. Okay, and so that's on the one hand, it's like that's great. They really value their people. On the other hand, if we start to have budget shortfalls or cash shortfalls, which we've had for the last 4 years now, meaning we are bringing in less cash than we are spending. Luckily, we had a big cash reserve, but that cash reserve is shrinking as we do that, right? If you have $50 million in cash sitting there, and this year you spend $4 million more than what you brought in, well, then at the beginning of next year you'll have $46 million in cash, right? And so you can't do it forever. So this value we've shown our employees by giving them raises and by really, what does that mean when we have a cash shortfall? What are our options? Yeah. So that's the precarious situation the college is in right now. Can we do this with maybe just as people retire, not filling their places and instead putting a little more load on the other faculty in their area? Or are we going to have to lay somebody off, right? Some person say, hey, you're the least senior here, and or are we going to have to ask everybody, you know how you've been getting raises over the last several years? Well, how about we do sort of a reverse raise, right? You got to try to sell it so it's, there's no good way to tell someone to get paid less. Yeah, a reverse raise, all right. So this is when a big chunk of your budget is salary and wages. Then when cash gets tight, the only thing you can really cut is salary and wages. And so that's the challenge we're facing, is saying what other things can we cut before we cut that, before we start impacting people, individuals. And then is it better to impact everybody a little bit, say, hey, we're going to have to take a 5% pay cut across the board, and we'll do it spread out over 3 years, so it's just like a little bit each year. Is it better to do that, or is it better to, for lack of a better term, go on the witch hunt, identify those people who don't seem to be bringing in revenue commensurate to their wage, and just get rid of them? But remember, when you get rid of someone, that someone has mouths to feed and mortgages to pay. And so that's the real challenge, right? You don't want to just be heartless, especially if someone, say, isn't bringing it in, but it's not because they're not a great teacher. It's just because their program is small or something like that. You have to be careful. All right, so that's what master budgeting is all about. This is where, if you're the person at the top, everybody thinks you're the Grinch. And, well, welcome to life, right? Everybody's the Grinch. I guess I should plug this in. All right. Or not. All right, so there's your learning objectives. I guess you could read those if you want to. I'm not that worried about them. I think when you read the textbook, it's good to look through the learning objectives, but I don't think we have to spend a ton of time on them. All right. So most of you know what a budget is. They define it as a financial plan to coordinate business activities. That's probably a good definition. And those are all the things we use budgets for. Here's the thing. You've got to plan for the future. You've got to think tactically when you're at this level, and you've got to think strategically when you're at this level. Okay? And a lot of managers straddle the fence between tactical and strategic managers. In other words, you have to have a broad plan for your area, but it's got to be appropriate to the company's overall plan. But you've also got to be able to take that. That'd be the great thing about being a president or a vice president. I just make the broad plan, and then I give it to people, and they do it, right? That'd be great to be in that position. Most of us are in the tactical side, where we have to have this broad side, but we have to broad plan, but then we have to say, how do I take that broad plan and make it a reality? What are the things I do, and what are the measures I measure? And that's part of what we use this whole budgeting process for. So this is called a performance report. You'll notice that it looks a lot like an income statement. This one does, okay? The real difference is that you have a budget. Budget is another word for plan. And you have an actual, and then you have something called variance. You have to be careful when you look at this, and we'll talk more about it in a minute, that variance is in negatives and positives, but it's not always a negative thing or a positive thing. In other words, if you have less revenue than you planned for, that'd be negative, right? I planned on having $600,000 in revenue, but I only had $589,000. If I have fewer expenses, less expenses than what I planned for, that's a positive thing, right? I actually kept my expenses lower than the plan. This guy didn't, though. His expenses were higher. So his revenue was lower, his expenses were higher, and it was a little off, but it was pretty close, right? It was within, well, 1%, something like that. So that's a performance report. All right, So just so you know, if you go into business, say you go into big business and you work with a big business, the budgeting process will be a little different everywhere you go. Okay, that's a lot of accounting is like that, where you learn it in school and then you go there and you're like, oh, that's a little different. It's okay, that's just life. Especially with managerial things, where there's not some law dictating the way it's done. Instead, it's sort of like the needs of the business that dictate how it's done. And just so you know, like our fiscal year ends in June here at the college, meaning our new college fiscal year starts July 1st, and we start the budgets at the low level, so like the division level budget, I have to have those in February. So that gives them time to then put them into the academic budget, the operations budget, and those people approve it, and then it goes up to the chief business officer so that it's ready for implementation by July 1. So there's always a lead time. We don't need to spend a lot of time on it, but this is incredibly important. As a manager, you've got to really sell to the people the budget. Otherwise, what they're going to do is complain, I never have the things I need to get my job done. And so having conversations with them about what you can and can't do and why you can and can't do it is really valuable. Like, I don't know if you've ever worked for a top-down person who just doesn't tell you anything and just says, this is your job, and you don't get to any involvement in, maybe, well, most jobs you'd have at your age, that's kind of how it is. When you're working with professionals, think about working here at college, where every single staff member, or at least every faculty member, has advanced degrees. They're all professionals and expect to be treated like they're intelligent and their say matters to the institution. And so you've got a lot of egos involved. And so that's why they do it the way they do, where it starts at the bottom. So as a division chair, I go out to the members of the division and say, are there any needs that we're going to have that are different than we've had this year? And if they're bought in all the way up the chain, then the chance of there not being any real problems with the budget is really good. If the top just comes down and says, here's what you get. And so as we get in a tight financial situation like we are now, we've got to really kind of come back to the faculty and say, what are your thoughts? Do we start laying people off? We don't want to make people scared and like nervous about work, right? But we've got to get their input too and say, are the things we can cut out before we get to that? I don't know. Instead of the cleaning person coming every day, can they come twice a week and we can be responsible for wiping off our own desks and taking out our own trash? But then that cuts the job of the cleaning person, right? It cuts their hours. So, I mean, those are all things we're dealing with. And if we get the buy-in from employees, then the chances that the budget's going to work are way better. There are people who will thwart budgets just to be spiteful, right? They will find ways to spend money they don't have to be mean, because the government, because the company is just the man, and they're going to fight it. They're going to stick it to the man. Those people usually end up unemployed ultimately, but they can cause a lot of damage leading up to that. All right. So here's our types of budgets. We have what's called a strategic budget. That's the long-term plan, long-term goals, and the operating budget, short-term plan and short-term goals. Okay. We have what's called a static budget. This is where we're going to plan on our revenue and expenses for one level of sales volume, and then a flexible budget, which is prepared for various levels of sales volume. And I'll show you examples of them here in a minute. And then the master budget, like I said, is kind of all of these different budgets sort of all worked together. And again, I'll give you an example. So under the master budget, there's a capital expenditures budget. That's money we're going to use for purchasing long-term assets, such as parking lots. Okay. There's financial budget, so that's the cash budget and the budgeted financial statements. In other words, how much do we expect to bring in? How much, revenue, expenses, those sorts of things. And then the cash budget. Not only are we worried about what our revenue expenses are, but how much of that revenue will come in cash versus some receivable to be paid later, right? And how much of those expenses have to be paid out in cash versus being able to be put off to some future point. This is where it really matters, right? I could have positive revenue, but if I'm not collecting it, I could have negative cash. Negative cash kills businesses because you can't pay the bills. And so understanding how the cash flows through your business and planning for it really matters. I think I've told you that Freeport-McMoran Copper and Gold Incorporated, FMI, they have so much clout in this area. Every contractor wants to work for them, that they get to set the terms of their payment. And the terms they set are 120-day terms. Norm is like 30 to 60. They're saying, we won't pay you until 120 days after you perform the service. Okay, so if you're a small company, let's say you run service trucks and you've got 4 trucks going and the drivers of those trucks, and maybe you have a mechanic who works on the trucks. Well, you've got to make your payroll and buy fuel and pay insurance and all those things on those trucks for 120 days before you get paid for the first bit of work they did, right? And if you don't plan for that, you're screwed. You've got to plan for that. Number one killer of businesses is failure to manage cash flow. Do you guys know what percentage of small businesses fail in the first year, roughly? 50%. Don't make it a year. So as we started working and I was doing study on mitigation of business failure or reducing the risk, there was already some studies out there. That's always the first phase of study anyway, right? Is to go out and see what's already out there. Small Business Administration had done a study. They'd found that there were 8 reasons that accounted for 92% of all business failures. And so rather than reinvent the wheel, what my goal was to create a little program where anybody who came to me as a consultant to want to start a business, we would work through those 8 things and ensure they understood them and make a plan for dealing with them. And in 2 years of doing that, we had a 92% success rate, an 8% failure rate. Not because I was smart, but because I just got people to make a plan that considered the risks and mitigated those risks, right? How do you, so if you recognize I'm not going to get paid for 120 days, then you have a lot of cash when you first start so that you can cover expenses. So that when someone says, I want to start a business, and we do some math and we say, you're going to need $250,000 in cash to float you until you start making real revenue. And they go, I only have 50,000. What do? We either put off the start of the business or we find some cash, one or the other. And so that's the importance of all this budgeting, is knowing where's my revenue coming in cash and what am I going to have to pay in cash. So this looks more complicated than it is, but this is kind of how all of them flow together into the master budget. We have the operating budget and the financial budget. The operating budget has our sales. That's an estimate of how much we're going to sell. Production, how much we have to produce in order to cover what we're selling, right? We have direct materials, direct labor, manufacturing overhead budget. Those all fall under the cost of goods sold budget. Selling and administrative expense budget, and that all flows into the cash budget. The cash budget, then also we have the budgeted income statement, balance sheet, statement of cash flows, and then capital expenditures is kind of its own thing over here. If you think about it, it's not rocket science. Really what it is just a bunch of different moving parts that you have to take one piece at a time. And this chapter will be an exercise. You have a mega problem, okay, of taking it one piece at a time. All right, so here's how we do an operating budget. I just told you all the thing a master budget includes. So the first thing we have to do is forecast our sales. In real life, what you usually have is history working for you. You say, well, we tend to sell more of this in the first quarter or whatever, right? So really, budgeted sales is just the budgeted number or budgeted volume in sales times the sales price. That's all, okay? Again, in problems, they're just going to have to tell you stuff. Real life, it's actually harder, right? We have to say, okay, how much do you think we're going to sell? I think I told you guys about consulting for a guy starting a funeral home, and we had to figure out, well, what's his sales going to be? Well, his was actually easier than most. Why? Because we could go to the county and say, can you tell us how many death certificates were issued for the last 3 years by year? And then we could budget from that, right? We could say, okay, if that many people die, if we think that we can get 30% of the funeral business in the area, what's the breakdown? How much do cremation? How much do, we could start to forecast or budget our sales in dollars. Once we know how much we think we're going to sell, we do a production budget. If you know you're going to sell a certain amount of stuff, then you have to produce that much stuff, right? So we really just take how many we think we're going to sell plus whatever amount we want to keep in inventory, right? You always want to have some on the shelf. You don't want to just sell everything you have. That gives you the total that you need minus the amount you have gives you the amount you need to produce, or if you're a retailer, the amount you need to purchase from a supplier. That's all a production budget really is. So you'll see the number that they have budgeted to be sold plus the desired tablets and ending inventory give them the number that they need. Subtract out how many you already had in the beginning, and that gives you the amount you need to produce. You'll notice the desired tablets and ending inventory flows from here to on the budget what will be the beginning inventory for the next period, right? The amount I intend to have at the end of this period should equal the amount I planned for at the beginning of the period next month, and so forth. So that's a production budget. Now that you know how much stuff you're going to have to produce, you're ready to budget what you're going to spend on direct materials, the materials that go into the things you're producing. Same concept, the number we have to produce times the direct materials cost per unit gives us the direct materials needed, plus what we have in ending inventory, what we want to have in ending inventory gives us the total needed, minus the materials in beginning inventory tells us how much we need to budget to purchase the direct materials. So part of what's important for this chapter is that you become comfortable with this concept of here's what I need plus what I want to have left over tells me how much I need total, minus the amount I had to begin with tells me the amount I'm going to need to produce or to buy this period, okay? Like that pattern is consistent through each of these budgets, so you've got to get comfortable with it. There's an example of a direct materials budget, producing 410 tablets. There's $150 per unit cost, gives us the amount needed for production, plus what they intend to have in ending inventory, gives us the total amount of direct materials needed, less any amount in beginning inventory, gives us the budgeted amount to purchase. Again, so if you think about what this assignment is going to entail, it's going to entail starting sales budget and then building this budget piece by piece. Okay. Direct labor, I know how many I need to produce. I probably know how much I spend per, so I can have tablets to be produced times the hours put for each one. That gives me the total direct labor hours needed times the labor cost per hour gives me the budgeted labor cost. Okay. Manufacturing overhead is actually easy, even though overhead is always the confusing thing in this whole course. But in essence, all we do is say we get our predetermined overhead rate, and then we know how many we want to be produced. We're still going off the production budget. Multiply it by the rate we came up with, and that gives us everything we need. Okay, I think you guys will be fine. Cost of goods sold, beginning inventory, number produced, and sold tells us our amount of cost of goods sold. These are all projections, right? I showed you at the beginning of performance report, that's where we compared the projection to what we actually did. But at this stage, we're still just budgeting. So we're just making an estimate for the future. If you make a wrong estimate, is it going to put your company out of business? Theoretically, it could if it was like a really, really bad mistake and you didn't order enough material and you had angry customers. But you could probably work with it, right? Or if you bought way too many materials and it ran you broke. But hopefully, if you're still selling, you'll catch up on that. What you want is to have your estimate be as close as possible. It's never going to be perfect. It's an estimate. That's what budgeting's for. Do any of you use budgets in your own personal finances? I'm amazed at the number of people who don't. Who don't really know how much money they have coming in, don't really know what their expenses are. So they get a little extra money and they think, hey, I've got extra money to spend, when really you don't. Really you're going to have this cost coming up at the end of the month or something that you should have foreseen, but because you didn't plan, you didn't. Most of us do that. I teach this stuff, and as my income has gone up, I've gotten lazier about being careful about it. When we were young and broke, when we were in the military, we kind of had no choice. You just had to, every penny mattered. But in business, every penny really does matter. As we look at things here at the college and we say, well, if we stop doing this, we could save $10,000. One person can say $10,000 out of 50 million, that's insignificant. And my thought is, if I can save $10,000 in 5 different places, I just saved someone's job. I saved a human being their job. And so that starts to matter. Yes, it's a tiny amount. And actually, any one of us, from a budgetary standpoint, any faculty member here, we're insignificant to the overall cost of running the college from a dollar and cents sort of standpoint. But we're not insignificant as people. And so if we want to avoid being the cold, heartless corporate world that you kind of hear about, then we've got to think of people in terms of them being people. And we've got to think of dollars in terms of being a means to serve the people who work here and a means to serving the people who are our students. I can't think of any instructor here that I just want to fire. There's some I don't like as much as I like others. There's some whose teaching style I don't think is as good as others. But if I had to make the decision, it'd still be really tough. They're people. And most of them are making a real effort. Maybe we should do a student vote thing, like Survivor. Maybe a way to get rid of a couple instructors. What do you think? Do the secret video asides? I think so-and-so is going to get kicked off the island. Should we let the students choose? The Student's Choice Award. Anyway, it's not funny, right? Because it's people's jobs. So any amount we can save could save a job. That's important. If turning off all the lights is 1/10 of a person's job, then we should probably do that. All right. So selling and administrative expense budget. Again, that's all the expenses you'd see on an income statement. Again, in real life, you'd have sort of past experience on that. So here's the financial side. That's the cash budget and the financial statements. And the capital expenditures budget. Capital expenditures is interesting because, that's the money you're spending on the big things. How do I know if I'm going to need a new dump truck this year? Well, hopefully you have a good idea of the shape your dump trucks are in or whatever. People think the maintenance guys just do the grass and stuff, but the director of maintenance has to really know all of the assets they have. Am I going to need a new lawnmower this year? If so, they plan for it. I'm responsible for 45 Bernina sewing machines that are part of our Family Consumer Resources program here, which I didn't know I'd be responsible for that when I took this job, just so you know. Do you know how much a good Bernina sewing machine costs? About $1,000. So I got $40,000 of sewing machines sitting there. And the question is, maintenance on those machines will cost me $80 a machine. The manufacturer recommends twice a year. That's $160 times 40. That seems like a lot of money to spend every year to maintain those machines, but it's probably still cheaper than having to replace it in 6 years instead of 20. That's the sort of things we have to think of, and that's why it's best to have the decision-making happening at the lowest levels. I don't even know the machines. I turn to our FCR instructors and say, tell me about these machines and how we should be maintaining them properly. Do you think twice a year is necessary? Do you think we get away with once a year? Because they're a huge resource as far as knowledge of sewing machines. The people that teach our sewing and quilting courses here at the college. I don't know anything about sewing machines, so I turn to people who are more experts than I am. All right. And that's what you have to do. You know, if you're ever the boss, be freaking humble enough to recognize that people that work for you are smarter than you about certain things. You know, I've tried to make a habit of when I interview people, the person that I interview and I think, holy crap, they're smarter than me, that's the person I hire. It's a little intimidating, but guess what? You want people smarter than you around, at least in their area of expertise, so that they can provide you meaningful information. Being the manager doesn't mean you know more than everybody. It doesn't mean you're smarter than everybody. It means you take people who are professionals and experts and you leverage their abilities to come to some sort of whole for the organization. All right, you didn't know this would be a leadership course, huh? All right, so that's capitals, expenditure, cash budget. So cash receipts, how much cash we're bringing in, cash payments, and then short-term financing is another way we bring in cash. All right, so there's the cash receipts. We have total sales, and this confuses people sometimes, but you'll see that the way it's broken down is we're going to collect a portion of these sales. So if the sales were made in the first quarter, it looks like we're going to collect 180,000 of them in the first quarter and another 70,000 of them in the next quarter. And you can see that pattern holds true all the way down. Most companies recognize we're going to collect, you know, so much at the time of sale, we're going to collect another percentage of it next month, and we're going to collect another percentage of it the following month or whatever, okay? And again, in real life, you have experience to tell you how's that collection going to go, all right? So that's how you do a cash budget, is you just break down the sales, and then you have some idea of when you're going to collect on it. And that'll tell you how much cash you'll bring in during each period. Right? It'd be nice if everybody just paid at the point of sale. If you're McDonald's, you have that luxury. If you're Walmart, everybody pays at the point of sale. But for most companies, you carry some degree of receivable, and you're not going to get paid all of it right now. Cash payments, well, all the things you'd expect. Again, it looks a little confusing. They made it really tiny up here. Again, though, it says in this company they happen to pay 75% of their materials purchases in the quarter that they do it, or in the month they do it, and 25% in the next month. That's because you have some suppliers that want, you know, 10-day terms, some suppliers that want 30-day terms or whatever. So the problems will tell you that. They'll say this is the amount they collect that month, the amount they collect within 30 days or whatever. So you break down all those direct materials, payments, direct labor, and so forth. This is not as hard as it looks. Can you see why I've been trying to get you to use Excel more? Because Excel would make this job a lot easier than trying to do it by hand. Just the scope of it. In fact, most places that do master budgets, what they have is a bunch of tabs. And my first tab is my sales budget. And I do that, and then the information from the sales budget that needs to flows into the next budget, production budget. And the production budget tabs flow into, and so forth, okay? All right. Short-term financing, that's just borrowing money for the short term. That could bring in cash. Oh, they're just filling it in for you. So a budgeted income statement, just what it sounds like. Revenue, cost of goods sold. What it's telling you here is that the information for the budgeted income statement comes from the various budgets you've already produced. Right? You did a sales budget, so that's going to be your revenue. You did a cost of goods sold budget. That's going to be where your cost of goods sold come from. You've done a selling and administrative expense budget. You've done a cash budget. All that information flows into a budgeted income statement. And it looks like an income statement. In real life, if you ever do a budgeted income statement, make sure very clearly it's labeled as budgeted. You don't want someone to accidentally think it's the real income statement and post that for the investors. That's not good. All right. Budgeted balance sheet, same idea. Assets, liabilities, equity, you know what a balance sheet is. Statement of cash flows, same thing. Because at this point, when we're making the budgeted financial statements, we've already done all the other budgets in the master budget, and so the information just flows into these statements. It's not bad. That's it. All right. So I hope that I don't want you to be intimidated by this. I kind of try to scare you and say there's this big mega problem, and there is. But if you take it a piece at a time, right? How do you eat an elephant? No, with ketchup. Everybody knows this. No, yeah, one bite at a time, right? That's how you eat an elephant. You just take it a piece at a time. But be prepared for kind of like this lengthy, interconnected assignment. Think back to like Accounting 1, chapters 1 through 4. Do you remember that assignment that was like start with, what was it? It was start with journal entries, then make the adjusting entries, then make from the adjusting entries, you had to do a post-closing trial or an adjusted trial balance. Then you did an income statement, a balance sheet, or a statement of retained earnings and a balance sheet. Then you did the closing entries and you did a post-closing trial balance. Remember that? It's sort of strange that it's just sort of fun to watch the students each semester go through that and be like, why is this so long? And I'm like, compared to the rest of your life, compared to like raising children, okay, there is a strategic plan. What's this person going to turn out as a 30-year-old, and what are the things I need to be doing today to help them become what I hope they can become when they're 30 years old? And then what do I do when they completely screw up my plan because they'll do it just to be spiteful? You want to talk about strategic planning and bringing in tactical expertise. Good news is if you have 8 or 9 kids, you get better at it. So just your older kids are screwed up. Your younger kids are perfect. Okay, that's what I've discovered. All my younger kids are perfect. Guys, any questions about this? It's like everything else. Once you get into it, it's doable, but sometimes the concept at first seems big. All right? Very good. Then have a terrific day. Hey, if you weren't here at the beginning of class, I'm not going to be here again Wednesday. The same family situation I've had that had me out last week, I'll be gone Wednesday. So I apologize. The day after tomorrow, Wednesday. Why wouldn't we? Yes.
I was wondering,